Yes, we have made headline news again. So Tencent, the $317 billion Chinese tech giant, posts their first ever revenue decline. Tencent's sale fall for the first time as China's economy sink. You know what else is sinking? The like button, of course. So make sure you sink the like button. Another thing sinking alongside would definitely be my net worth, as I continue to stay invested in all these Chinese tech names. But that's besides the point. Also, this video is sponsored by Weibo. So I know many of you smart investors have already taken advantage of the sign-up rewards in the past 2 months. But in case you haven't, Weibo recently leveled up their game again, and from now until the 1st of September 2022, every new sign-ups will get up to $100 USD worth of Google shares, and on top of that, they added an additional $8.88 worth of Meta shares. So I'll leave the link and instructions down below. Essentially, you just need to deposit at least 1,965 Singapore dollars and execute a total of 6 trades in the first 30 days. And you'll get an 8% ROI from the sign-up rewards. Definitely better than Alibaba. So I'm currently using Weibo for my $15,000 portfolio as well. So don't let this guaranteed deal get away. Link in the description box. Anyhow, interestingly enough, despite a double miss on both revenue and also earnings per share, Tencent actually gapped up 4.8% the following day in the Hong Kong exchange. So what a time to be alive. So I'm here to look into Tencent's latest results. So we should stop with the jokes. Let's be real, it was not a pretty quarter. In fact, it has been 2 consecutive disappointing ones. The first quarter, Tencent did 0% year-on-year. The second quarter, it's negative 3%. The same can be said for Alibaba as well. So the unraveling of the property crisis, slowing economic conditions, the pandemic controls, you know, the same old China is gonna go bust story, I will not belabor the point. Comparatively, if we were to look on a percentage basis, it does seem like Alibaba is probably holding on a little better, but I think there are specifics we should get into. So the foreword provided by Ma Huateng basically covers most bases for many Chinese companies today. And I quote, "We actively exited non-core businesses, tightened our marketing expenditures, and trimmed operating expenses, enabling us to sequentially increase our non-IFRS earnings despite difficult revenue conditions." So it's a recurring theme by now where many Chinese companies will blame the weak macroeconomic environment. Complementary data points coming out from China are probably painting the same doom and gloom scenario as well. At the end of the day, you have to make your own judgment on whether will this be temporary and will the companies you invest in come out ahead after this entire economic boom and bust cycle. So in the words of CEO Ma, he still believes that it would position them for revenue growth as China's economy expands. So you decide. So looking at top line revenue growth, it plummeted 3% on a year-on-year basis. So the biggest culprit for this slowdown was actually its advertising arm. So online adverts were down 18% year-on-year, reflecting notable weakness in internet services, education, and the finance sectors. So I think you guys are smart people. I wouldn't really go behind the intricacies and the mechanics behind the causal relationship, but this might just be a foreshadowing, especially for investors in the American counterparts that are both advertising juggernauts in their own rights. I'm not going to name names. So I guess it just depends on how bad the slowdown would be for the rest of the world, if any. Knocking on wood, of course. So drawing the same context, a core part of Alibaba's business also revolves around advertising, and of course an additional take rate on their e-commerce platform. And this is actually booked under Customer Management Revenue segment under China Commerce in Alibaba's financial statement. So in their presentation, CMR actually declined 10% year-on-year, and they cite that the primary reason to be because online physical goods GMV generated a declined mid-single digits year-on-year. And since we don't have the actual breakdown of the mix and the attribution of the revenue under CMR, you can probably estimate that the advertising revenue was also down in the same range between 10 to 15% to contribute to an overall decline in CMR by 10%. So that said, I think the advertising dollars are much more stickier on Alibaba compared to Tencent, which will probably explain the difference in terms of magnitude of decline. Now, since we are already on the topic of comparing Tencent with Alibaba, let's look at the cloud vertical. Sadly, Tencent actually lumps both their fintech business together with the cloud business, so it might be relatively complicated to estimate, but let's try to do it anyway. So Tencent's fintech and cloud arm essentially stayed flat, up 0.8% year-on-year, while AliCloud grew 10% year-on-year. So for context, based on 2021 figures, AliCloud was the market leader with a 37% market share, while Tencent Cloud was ranked third with a 16% market share. So I'll try not to be biased here, but I think at least on this cloud front, AliCloud is probably executing a tad bit better than Tencent. But many shareholders are still unhappy with the rate of growth. And honestly, I can empathize as a fellow shareholder. So the only sliver of comparison we have is the proud announcement of their TD-SQL database. Whatever that means, it grew 30% year-on-year. But because it only represented around 5% of their cloud revenue, it wasn't enough to move the needle, which is why it was flat year-on-year. So it's essentially the same playbook when things are going slow. Economic activity slow down and people are just generally more prudent with their spendings and companies are more prudent with their upgrades. Finally, looking at the two core engines of Tencent, Wechat and their gaming division. So they basically both stayed flat as well. Okay, maybe a 1% decline. But first, looking at the gaming arm specifically, I think it's an implicit understanding that the domestic game industry is facing transitional challenges, including fewer big games released, lower user spending, and measures to probably protect minors as well. So that said, after the said policy actions being introduced, the revenues for current quarter was only down negative 1.1%. Interesting. So in the same vein, international games are much more affected by a post-pandemic era where players are resuming offline activities and revenues are down negative 1.4% year-on-year. So completely logical explanations, and if you were to compare to Sea Limited's gaming division, they booked a negative 12% year-on-year on their top line, and don't get me started with their bottom line. So I'm not going to name names, but I've seen articles comparing Garena, which is Sea Limited's gaming business, with Tencent, and saying that they are in a similar of quality and are reliant on one-hit games. So I would suggest for potential Tencent investor to dig deeper into Tencent's gaming business, and for commenters on the sideline to do extra due diligence before making such sweeping statements. At least from the growth perspective, Tencent's gaming business proves to be a lot more resilient comparing it to Sea. On the flip side, comparing it to Netease, which is a Chinese gaming company, they managed to grow their top line by 15%, with half of Tencent's gaming revenue base. So I just wanted to ground you guys with a fuller context and comparison to show both the good and the bad and not trying to hide anything. Lastly, which is also arguably the most important business of Tencent, Wechat. Revenue were flat year-on-year, but monthly active users reached 1.299 or 1.3 billion people, and that's what matters anyway. So for investors, never forget this slide of the presentation. There's a reason why the communication and social gear of the Tencent business is larger than everything else. Wechat and QQ is the lifeblood of the business empire that enables the rest of them to gain that competitive advantage. And even though the revenue attribution from the Wechat arm don't really reflect that, Mr. Ma knows what he needs to do. So for investors that still think that the gaming arm or the cloud arm or the fintech arm is the most important business for Tencent, remember to print this slide out, burn it and drink it. Investing into Tencent is investing into Wechat and by extension, China. Last point I wish to make, I think it's a common concern for both Alibaba and Tencent with regards to their shrinking operation margins. Previously, if the company is growing top line by a huge quantum, I think investors are a lot more kinder by overlooking the shrinking margins, because ultimately, the growth more than compensates the bottom line margins. However, at least in the most few recent quarters, you can see that growth is at best stabilizing or even facing negative growth, albeit small, with a shrinking margins alongside. So if this trend continues, then yes, it's a call for concern. So I think I have 2 points to make. Number one, I think by now, you should know my position on top line growth. It's probably going to be a rather turbulent times for Chinese companies ahead in the weak macro backdrop in the near term. But I'm fairly confident that these Chinese companies that I own will recover strongly. I don't know the exact date, but I'm investing for the distant future. Number two, I think it might be a little too early to conclude that margins will fall off a cliff from here. So many of them are already pledging for cost controls and much more prudent financing decisions. So give them 2 more quarters and we can see if they are smoking investors or not. So with that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!